Hello everyone, welcome to the 22nd episode of me learning how to trade using Forex. So in the last video we were going through chart patterns and trading the trend, and we managed to read through half of this and we've stopped to about here. If it doesn't, hammer's failed, so that's what we got to. Hammer's failed. And in this video we're just going to carry on before where we left off, so yeah, let's get going. Morning star. Morning stars are commonly used commonly used triple session candlestick pattern. Triple session, so 3 candlesticks. How do I do it right? Morning star. Commonly used triple session candlestick pattern. Like hammers, they offer an indication that a downtrend might be about to end with an impending reversal. Offer an indication that a downward trend might be about to end with an impending reversal. A morning star consists of 3 candlesticks, a long red candle, triple session candlestick pattern. Consists of a long red candle, a small red or green candle that gaps below the close of the previous session, okay, the previous candle, a long green candle. I should be offering an indication, right? If the second candle is a doji, aka one of these bad boys, if the second candle was a doji, then the chances of a reversal increases. The chances of a reversal increases. The trend is also seen as being stronger if the final candle gaps above the close of the second one. Trend is also seen as being stronger if the final candle gaps above the close of the second one. Wait, so this trend is also seen as stronger if the final candle, so that one there, gaps above the close of the second one. And close, whether it's that one or that one, gaps above the close of the second one. So aka, if it's a green candle, then green candle, so its opening price, right, its opening price is higher than the previous opening or closing price. So yeah, if it's higher than the previous one, then if it's higher than the previous one, then yeah, it's an upward trend, isn't it? Because you're selling it. You're selling it. If it's opening green, green, and it's a green candle as well, so it's an upward trend, isn't it? An opening price, that's being a sold one, isn't it? Opening, that's a selling price, isn't it? Opening price. And green sticks. Opening. Yeah. Yeah. Opening price. I think that should be the buying or selling price. I'm stepping tall in. Whoops. Controlling. 99. And what did they say? A morning star begins with the downtrend intact, as shown by the long red candle, and a gap to the next session. However, the second candle indicates indecision, which could be a sign that reversal is on the cards. Then the long green candle confirms that reversal is underway. Long red candle. So downward trend. Which shows indecision. Reversal, which shows a reversal. Cool. Chart patterns. So we were looking at candlesticks patterns, and now we're looking at chart patterns. Chart patterns present themselves over lots of trading sessions, so they tend to be longer than candlestick patterns. Over lots of trading sessions. So they tend to be longer than candlestick patterns. Triangle. One of the easiest chart patterns to spot is the triangle. There are three types of triangle to watch out for: ascending, descending, and symmetrical. Three types triangle. Ascending, descending, symmetrical. Ascending goes up, descending drops down. So it's just basically an upward trend with a horizontal line going across it then. In an ascending triangle, the bottom hits by a market gets successively higher, indicating a rising trend line. However, the trend pauses as the market fails to hit new heights on the upside. Instead, it keeps bouncing off a strong resistance level. So, ascending. Bottoms hit by market get successively higher, aka the rising of this, and this. Oh no, I guess this. So, bottoms get successfully higher, which shows a rising trend line. However, trend pauses as the market fails to hit new highs on the upside. Instead, it keeps bouncing off a strong resistance level, and this is the, so it keeps going boing, boing, boing. Keeps bouncing off a strong resistance level. Strong. Often occurring after significant uptrends. Because after strong significant uptrends, ascending triangles are continuation patterns. So if the market breaks through the resistance level, then a new rally may form. Ascending triangles are continuation patterns. If they break through the resistance level, then a new rally may form. However, the market drops below the lower trend line, then the pattern is voided. However, if the market drops below the lower trend line, then the pattern is voided. So if it drops below here, so if it goes like that and it goes pff, then the pattern is voided. If the market drops below the lower trend line, then the pattern is voided. I think when they say lower trend line, I think they refer to that line right there. Descending triangle are the exact opposite. Descending. After a downtrend, the market is a strong support level, but ever lower resistance. If the support is broken, a new bear run may appear. So, strong support level, bottoms get successfully higher. This one is highs get significantly lower, so highs get successively higher, successively, not successfully, successively higher, get successively lower, which shows a falling trend line. However, trend pauses as the market fails to hit new lows, keeps bouncing off a strong support level, often occurs after significant downtrends. If they break through the support level, then a new rally may form. Trading triangles. The simplest way to trade a triangle is to price an entry order just beyond the level of resistance on ascending triangle or support descending. So always do it on the flat line bit. Then you can trade the result price action. The simplest way to trade a triangle is to place an entry order just beyond the level of resistance on an ascending triangle or support on an descending triangle. Then you can trade the result price action. It is often a good idea to place a stop just beyond the opposite trend line. Then if the pattern fails, your position will close automatically. Often a good idea to place just beyond the opposite trend line. Opposite trend line, also where the slant is, basically. So trade is to place an entry order just beyond the level resistance. Beyond, so the level of resistance. Enter then you can trade the price result action. So you sell here and then you buy, I'm assuming somewhere over here, right? To make a profit. It is often a good idea stop loss, then you trend fail. So if you place a stop loss here on this level here, if it does in case go back up, like shoots up again, then you can just close the trade automatically and you won't lose that much money. Right, okay, symmetrical triangles, flags and wedges. So these three patterns all look a little bit different but are similar in how they work. symmetrical triangles, flags, wedges. These three patterns all look a little bit different, but are similar how they work. All look different, but similar in how they work. Symmetrical triangles, flags and wedges are all formed by two trend lines that indicate indecision in the market. All formed by two trend lines which indicate indecision in the market. Then, if either trend line is broken, they may lead to a new rally in that direction. Either trend line is broken, it may lead to a rally in that direction. In a symmetrical triangle, two trend lines point towards each other. The first connects a series of lower peaks, while the second connects a series of higher troughs. Should they call it lower troughs and higher peaks? But okay, I guess it's just me then. So symmetrical triangle. Two trend lines point towards each other. Connects a series of peaks whilst other connects a series of troughs. In a wedge. So that's that. In a wedge, two trend lines point towards each other. While sloping in the same general direction. In a rising wedge, the upper and lower trend lines both point up. In falling wedge they slope down. In a falling wedge, the upper and lower trend lines both point down. And it looks like that. Copy. So the triangle ones meet up basically, whereas the wedges are parallel, so they won't meet up, right? I think that's what it says. in a flag, two trend lines run in parallel whilst sloping either down, bull, or up, bear. Bull flags after a significant move up. Bear flags appear after a move down. No, so this is parallel. So the wedges aren't parallel, meaning they'll eventually meet. So two trend lines point towards each other while sloping in a general direction. So I guess the flag one is more strict version of the wedge one, where they won't ever join up the flag. The triangle is easy to spot because you just see the join up, and the wedge is like in between, I guess. Right. In all these patterns, the market is in a period of consolidation that is often accompanied by falling volatility and volume. Market in consolidation is often accompanied by falling volatility and volume. During the pattern, the market cannot decide whether to break up or down. Once either trend line is broken, there may be a substantial move in the direction of the break. If the market breaks up, then it may start to rally. If it breaks down, it may signal bear run. Bear run, aka going downwards. Oh no, going up. No, going down, sorry, going down, because it slopes down. You can either trade any of them by entering position once the market moves beyond either trend line. So, trading triangles, wedges, flags. Entering a position once the market moves beyond either trend line. Again, it is often a good plan to set a stop just beyond the opposite line. Good practice to set a stop just beyond the opposite line. So this one, you buy in, wait, you can trade any of the by entering once the market moves beyond either trend line. So you can either sell here or buy here. You can either by entering once the market moves beyond either trend line. No, you won't sell here because the market's going to go up, but you wouldn't know whether it's going up or down. That's the question. moves beyond the trend line. Right, okay. Test your knowledge. Which pattern is represented on this chart? This is not a triangle because a triangle would look like that. It is not a doji, so it must be... No, wait. Which pattern? I thought doji was only a single candle. Is it talking that one? The green one? I'm assuming it is. Which pattern is represented on this chart? There's so it's morning star, isn't it? Because I'm assuming it's talking about these three. Which pattern is present on this chart? A wedge, ascending triangle. That is not a triangle. A wedge. I think it's a flag, isn't it? No, it's a wedge. Because wait, if I skip through again, it kind of joins up, right? Like here. No, wait. Point towards each other while slope point towards each other. So they would join up at the end then. Well, it depends where you draw your lines then, wouldn't it? If you... Wait. Up, down, up, down, up, down. Down, up, down. So draw a line here. You draw a line here. Up, down, here. Here. What? Wait, let me compare this. Wedge. They said it's a wedge, isn't it? So you get that one there, which is that one there. You get a little bounce up, which is that one there. Get a little bounce down, bounce up, bounce down. I'm assuming you can draw a line from here to here, and then you got from here to here. So yeah, it's a bit iffy, very iffy. Right, okay, trading with indicators. The final part of technical traders toolkit that we're going to cover in this course is technical indicator. What are technical indicators? Technical indicators are tools you can apply to a market's chart that uses mathematical calculations and formulas to give you an extra insight into its price movements. Indicators use mathematical calculations and formulas to give you an extra insight into its price movements. Gives you an extra insight into a market. Instead of relying on patterns formed by an asset's live price, they offer an additional dimension to assist in making trading decisions. There are hundreds of technical indicators you can use when trading, and more are created all the time. However, they fall into two main categories: trending markets and non-trending markets. Categories. Trending markets. Indicators for trending markets help you stay on the right side of an asset that is on a bull or bear run. Trending markets help you stay on the right side of an asset that is on a bull or bear run. Non-trending markets. Indicators for non-trending markets can signal when an asset is overbought or oversold in the long term. When an asset is overbought or sold. Oh no, in the short term. Lots of traders will use technical indicators to refine their timing. Others will use them to determine the strength of prevailing trends so they can decide whether the opportunity is worth the risk. Essentially, most indicators take complex calculations to automate them on your chart. While the formulas themselves may be tricky to understand, the art is learning how to interpret the signals they generate. Need to learn how to interpret the signal. Do you need technical indicators? To some technical traders, indicators are everything. They don't believe that a chart can be called a chart without extra bells, whistles and lines attached. That isn't the case, and many experienced investors can read price action without any distractions. However, indicators can offer a useful method of analysing markets and finding new opportunities. Drawbacks of technical indicators. As technical indicators derive their figures from market's price, most will be lagging or backwards facing by their nature. By the time you come to apply the results to a live trade, the opportunity may have passed. Like any trading tool, they are not 100% effective and should be used with caution. Plus, indicators are usually subjective. Two traders may well derive completely different conclusions from the same one. Indicators are subjective. We're going to take a look at 3 commonly used indicators in the next lesson, but before we do that, let's take a look at the most popular one of all, moving averages. Moving averages smooth out a market's price movements over a given period so you can see through the noise and spot general trends. So you can see through the noise and spot general trends. They are created by averaging out a market's closing prices over a given number of sessions. Averaging out and by sessions is the number of candlesticks, I'm assuming. You can create moving average from any time frame you wish. A 20-day moving average, for instance, will show you a market's average price over the past 20 days. A 5-day moving average, on the other hand, averages out the last 5 days of price action. types of moving average. There are a few different types of moving averages which calculate averages in different ways. The two most popular though are the simple moving averages and exponential moving averages. To calculate a market's moving average, you divide the total of its closing price over a given number of sessions by the number of sessions. So to calculate Amazon's 5-day simple moving average, you take the sum of its closing price over the last 5 days and divide by the figure by 5. Calculating exponential moving average is a little bit more complicated, as they give more weight to price action that is closer to today's state. Right, okay, so exponential averages give more weight to price action that is closer to today's date, which means that EMAs or exponential moving averages generally react more quickly than other moving averages. When you use a moving average on a chart, it will automatically recalculate for each session. So you see a trend line following your market's price. The more days you include in the average, the further it will appear from a live price. Which I think makes sense, because the more data points you include to calculate the average, then the more the average is going to move around, because you're going to have to include more numbers in, so that's going to mess up the average. So yeah, that makes sense. The most popular moving averages cover 5, 10, 20, 50, 100 and 20 days. Five, 10, 20, 50, 100, 200 days. Trading with moving averages. In general, a market may be considered bullish when it's trading above its moving average, and bearish if it's below. However, there are a few other common signals that traders might look out for. A buy signal if the moving average is rising and pointing up. buy signal if the market closes above the moving average. Sell signal if the moving average is falling, pointing down. The market closes below. Okay, moving average crossovers. I think we're going to leave this episode here, and we're going to finish off the rest of this in the next video. So yeah, thank you for watching guys, and see you in the next video. Peace out.